Hello, my name is Paul Carter, and I am the Chief Investment Officer of Capstone Asset Management. Following this introduction, the video will transition into Capstone's quarterly review for the fourth quarter of 2024, which was recorded on Thursday, January 16th, with Clayton Rutquist and me in conversation with Janet from our private wealth team. This video is meant to give you a broad overview on what we are seeing in certain markets and the economy in general. However, if you wish for more information on a specific fund that you are invested in, I encourage you to visit our refreshed website where you will find each fund's quarterly commentary. These commentaries provide a more detailed overview of that fund's investment landscape, as well as information on its recent performance. These are posted on our website by the end of the month following each quarter. Lastly, I would like to express my sincere gratitude for entrusting Capstone Asset Management with your assets and for the continued confidence you place in our stewardship. Thank you.
Welcome to our fourth quarter video update for the year 2024. Today, I would like to welcome back Paul Carter. Paul has recently accepted the permanent appointment of Chief Investment Officer, so congratulations, Paul. And we're also pleased to welcome a new face on this edition, Clayton Rutquist, who is our Director of Real Estate Investments. Welcome to both of you. Clayton, many clients will not have met you yet, so can you give us a brief introduction on yourself and your role at Capstone?
Certainly. My hope is that I'll meet many of you in the future, but pleased to do a bit of an intro now. I live here in Langley and started at Capstone in March of last year, so quickly approaching the 1-year mark already. And I've been in the industry for 25 years. So my career started on the lending side of the business, holding senior roles with GE Capital, HSBC, and CIBC, where I led teams of commercial bankers, worked in corporate banking groups, and covered a lot of industries in addition to real estate. I'm a CPA, which enabled me to leave the lending world after 17 years and step into the developer side of the industry, leading the finance team for a large family office in Kelowna. While I was there, we were involved in a number of different projects. And so I led the team from a finance perspective, at least in property management, leasing, and construction of all asset classes. So we were involved in industrial, residential, retail, office, and we even built a hotel while I was there as well. When my wife and I decided to move back to Langley, I went into business on my own as a commercial debt broker, a role I did for 4 years before being made aware of this opportunity at Capstone. So in short, I've been a lender, I've been a borrower and investor, and I've been a broker. So really have seen this industry from all sides and through multiple economic cycles. Now my role here at Capstone is the Director of Real Estate Investments. And so I lead the underwriting and real estate team for our 3 mortgage pools and work directly with Glenn, who's the portfolio manager of these funds, and with Paul in his role as CIO. I also do have input into the real estate deals that are held in the equity funds. And with that, as you can imagine, every day is a little different, but primarily I'm reviewing new and existing deals, structuring and negotiating the terms of those deals, and working with our various partners in order to maximize the value of our portfolios. I've also been able to bring my experience from working at those various different lenders to help us improve our systems and processes. I joined Capstone because I was excited about the opportunity to have an impact and to help drive the business forward, and that's exactly what we were working to do.
Well, Clayton, we're really happy to have you here, and we know you'll continue to make a positive impact to our team at Capstone. Paul, I'm going to go over to you now. So I know we've spoken a bit about the US election in our last update, and now we're into 2025 with an election coming up for Canada later this year. There's already talk of a lot of changes coming underway, some which may impact Canada quite greatly. How could this play out not only in the stock markets, but also how could this affect our other funds?
Yeah, great question, Janet. So we're in for quite a year, and the next few months are definitely going to be eventful and maybe even a little bit turbulent. So March 9th is a key date. That's when the Liberal Party picks its new leader, and that will, of course, decide who Canada's next prime minister will be. Some big names are in the mix, like Mark Carney, who just launched his bid today, former Finance Minister Chrystia Freeland, and then Government House Leader Karina Gould. And keep in mind that Parliament is prorogued until March 24th, so things will be on hold for now. But once Parliament resumes, the very first thing they'll vote on is a confidence motion. Now, if the government loses that vote, we will be looking at a snap election maybe as soon as mid-May. With the current political climate, it seems like Pierre Poilievre and the Conservatives could take it in a landslide, which could mean that the new Liberal leader, whether it's Carney or Freeland, will probably not be Prime Minister for very long. Now, if we zoom out a little, longer term, I think Poilievre would be great for Canada. His policies are expected to be more business friendly, which could be a real boost for the Canadian economy. That's good news for Canadian investments. If his government puts the right policies in place, it could lead to a more favorable environment for growth and stability, and by extension, better returns in the markets. Now, while all this uncertainty may weigh on the markets a little bit, there's a much bigger issue right now, and that's what's happening down in the US. President-elect Trump is about to take office in just a few days, and he's vowed to impose 25% tariffs on everything Canada exports to the US. If that happens, it could have major ramifications, not just for our funds, but for the whole economy. The big question is, when and how will he act? Will he move fast or take a more gradual approach? And will Canadian energy products, which are so critical to US needs, be exempt from the tariffs? If not, how might Canada retaliate? Could this even escalate into a full-blown trade war? It's a concerning thought because trade wars hurt everyone, and both countries would feel it. For our equity funds, this would likely be a negative, at least initially, but it's not all bad news. A weaker Canadian dollar, pretty much a sure thing if these tariffs come through, could actually boost the value of our non-Canadian investments. And for our mortgage and fixed income funds, it's a bit of a mixed bag. Higher tariffs could push inflation up, which would result in higher interest rates. Now, that could present challenges, but it could also mean higher income for some of our private fixed income investments tied to shorter term rates. Now, in the end, and I don't mean in the next couple of days, but over the next weeks and months, I do think cooler heads will prevail. These uncertainties are unsettling right now, but markets have a way of adapting. We're staying on top of everything and positioning our funds to handle whatever comes next, both the risks and the opportunities.
Thanks for that, Paul. I guess we'll see what happens there. Clayton, we have seen some headlines about developers under pressure, some anecdotal stories about developers being pushed into receivership. Can you give us both the macro views of what you are seeing in the mortgage lending space, and perhaps also comment on why the micro is actually more important, and how we attempt to circumnavigate these tumultuous times?
Yes, these foreclosures on commercial projects typically involve large sums of money and therefore make headlines that people are very interested in. The reality is that in most cases, these take a long time to unfold, and there's a lot of work that's been done before a project enters this scenario. Receivership and realization are the last case option when all other efforts have been exhausted. Essentially, what has happened in a lot of these cases is that the developer could not stay ahead of the cost increases that resulted from the pandemic economy, and then were hit with a double whammy of increased interest rates. So project budgets increased with inflation, and then the interest rate paid on those increased costs also increased, so that pushed the cost base beyond the value. In land-only deals, it's a similar scenario, where the slower market meant longer timeframes at elevated interest rates, often pushing debt levels beyond the value of the property. That's the direct cause and effect of the majority of the receiverships that we see and hear of. With interest rates now abating and inflation seemingly tamed for the time being, there's a much more stable cost environment in front of us in which developers can once again work on performance that have some level of certainty to them. So how do we operate in this environment, and what can be done at the micro level, as you put it? The primary answer to that is doing an extremely thorough job of underwriting and being cautious with deal selection. We turn away deals all the time and are a small enough fund that we can be very picky in terms of what specific deals we invest in. This is where my background and experience and the combined experience of our team comes into play. From an underwriting perspective, that means doing a deep dive into the borrower's sources of capital, details of their net worth, and their experience. It also means using my corporate banking and accounting background to dig through the financial statements and really understand who this borrower is and what recourse we have to secondary sources of repayment and to what level they can support a project with cash if the project itself experiences challenges. What I mean by deal selection is looking at and understanding the local market dynamics and specifics of the project itself. Does this project have competing inventory? How deep is the customer pool for that asset class? Is there a track record of that type of project succeeding in that local market? These are all things that we dig into on every deal that we look at. It's somewhat similar to how Paul would choose investment opportunities for the equity funds. If you find an industry you want to invest in, say AI or oil and gas, that doesn't mean you buy the first company you research. It takes patience and effort to look for the right opportunities, and we turn deals away all the time. In instances where we already have investments on the books that have not performed due to the extreme challenges of the pandemic economy, we take that same patient approach and look for the best way to move that project forward. With all the recent government directives to build more density, we've patiently worked with a number of existing borrowers who have taken the opportunity to reshape their project by going back to the drawing board and reapplying to the city to increase density on the site, and in some cases, even convert the project's use. For example, building a rental project instead of a condo project. I focus a lot on the housing sector as that's what typically makes all the headlines, but I want to point out that we do have investments in industrial, in office, in commercial, and retail, and all the same principles apply there as well. So to summarize all of this, yes, real estate rides the waves of the macro environment, but in reality, it is about as localized of as an investment as you can find. Your property is your property, and you can't just pick it up and move it.
Great insights there, Clayton. And Paul, we have a final question for you today. Given a lot of economic uncertainty, and not just within Canada, but I would say globally, what are some potential opportunities that you are seeing right now, either in the public or private space?
Yeah, I think it's always a good time to look for opportunities in the investment markets, and it just depends on picking your spots a little more carefully during times of uncertainty. Right now, I actually think it's a much better environment to be selective in what you invest in than we've seen in years. Take the equity markets, for example. There's been a huge focus on large cap growth stocks, particularly those tied to artificial intelligence. NVIDIA is a prime example, currently trading at over 50 times earnings. In Canada, our big tech name is Shopify, and it's trading at nearly 100 times earnings as of this morning. These kinds of valuations suggest a lot of optimism is already priced in. But if you're willing to look beyond these kind of high growth names, there are still plenty of opportunities in more value-oriented areas of the market. Sectors like financials, utilities, and telecoms stand out to me right now. Globally, the valuation gap between growth stocks and value stocks has rarely been as wide as it is today. And that creates opportunities for disciplined investors. And it's not just about picking individual stocks. Through our multi-manager pools, we've uncovered some pretty fascinating opportunities. For instance, about a year and a half ago, we came across a boutique asset manager in Vancouver called LM Asset. They're a deep value contrarian firm that runs a concentrated portfolio focused on special situations. What's really interesting is that it's run by two lawyers, Daniel Lau and Christine Mann, who bring a pretty unique perspective to investing. Now, after spending time with them, understanding their strategy, and doing our due diligence, we made our first investment in their fund through our traditional equity pool at the end of 2023. And in last year, they delivered a remarkable 66% net return for our fund, double the US market and triple the Canadian market. Now, beyond public equities, we're also seeing some opportunities in areas like commercial real estate and private credit, where pricing dislocations have created some pretty compelling entry points. Now, these are asset classes that require careful analysis, but they can offer attractive returns for those willing to look closely. Over the next few quarters, we'll share some of the investments that we've recently made in these spaces. But at the end of the day, uncertain markets often present the best opportunities if you're willing to do the work and to think a little bit differently.
Well said, Paul. So, to both of you, thank you so much for taking the time to join us today, and we look forward to having you with us again soon. And to our viewers, we hope you have enjoyed this quarterly update, and please stay tuned next month for our next edition of Your Wealth Matters. Goodbye for now.